A janitor with no college degree, no Wall Street connections, and a coat held together by safety pins died and left behind $8 million. No inheritance, no lottery ticket, no crypto scheme, just a guy who understood one thing that most people never figure out. His name was Ronald Red. And by the time we get to the end of this video, you will understand exactly how he did it. And more importantly, how you can too. Most people think investing is complicated. They picture men in suits yelling numbers at each other, or a 22-year-old on TikTok who apparently turned $500 into $2 million. They get overwhelmed and do nothing. But here's the truth. The actual process of building wealth is not complicated. It is just boring. And boring is exactly what makes it work. So today, we are going to walk through every single asset class you need to know in plain language, step by step. Stocks, bonds, real estate, gold, crypto, and the one number that quietly destroys more wealth than any market crash ever has. Let us start from the very beginning. Step 1. Do not invest yet. Before you buy a single share of anything, you need a cash buffer. Think about what happens if you put all your savings into the stock market and then your car breaks down next month. You are forced to sell your investments to cover it. Maybe the market is down that week. You just locked in a loss. That is exactly how people get hurt, not by bad stocks, but by bad timing forced by a lack of cash. The rule is simple. If you are single with a stable job, save 3 months of living expenses in a regular savings account before you touch a single investment. If you are supporting a family on one income, make it 6 months. If you are a freelancer or run a business, you want 6 to 12 months because your income is unpredictable. This money is not an investment, it is a firewall. Step 2. Kill the expensive debt first. Here is a question. If I told you there is an investment that guarantees you a 22% return this year, would you take it? Of course you would. That is exactly what paying off a credit card with a 22% interest rate does for you. The historical average return of the stock market is about 10% a year. Carrying a 22% debt while investing is a losing formula. One exception: if your employer matches your retirement contributions, grab that first. A 100% match is a guaranteed 100% return. Nothing in any markets can compete with that. Capture the match, then destroy the debt. Once the toxic debt is gone and your emergency fund is full, you are ready. Step 3. Understand what you are actually buying. There are 5 main asset classes every beginner needs to understand. Each one behaves differently. Each one serves a different purpose in your portfolio. Let us go through them. Stocks. When you buy a stock, you buy a small piece of ownership in a real company. If that company grows and makes money, your slice becomes more valuable. Stocks have historically delivered the highest long-term returns of any asset class. The S&P 500, which tracks 500 of the largest American companies, has averaged about 10% a year over decades. But that growth comes with a cost. Stocks drop, sometimes hard. In 2022, the market fell roughly 18% in a single year. If you panicked and sold at the bottom, you turned a temporary paper loss into a permanent real one. For beginners, the smartest move is not picking individual stocks. It is buying an index fund or an ETF. An ETF pools your money together with thousands of other investors and buys tiny pieces of hundreds or thousands of companies at once. One purchase, instant diversification, usually very low fees. Fidelity, Vanguard, and Schwab all offer these. There are also target date funds, which automatically shift from aggressive stocks to conservative bonds as you get closer to retirement. You set it, forget it, and let it run. Bonds. A bond is a loan. You lend your money to a government or a company. They pay you interest on a fixed schedule and return your original money at the end of a set period. Bonds do not grow as fast as stocks. That is the trade-off. What they give you is stability. When the stock market crashes, bonds typically hold their value or even go up. They are the shock absorbers in your portfolio. The main risk with bonds is interest rates. When rates go up, the value of existing bonds goes down. Right now, as the Federal Reserve is gradually cutting rates from their recent highs, Bond investors are watching this closely. U.S. Treasury bonds carry almost zero risk of default. Corporate junk bonds pay higher interest but act more like stocks in terms of risk. Know what you are buying. Real estate. Real estate gives you two things at once: rental income and property appreciation. The problem is that buying physical property takes a huge amount of capital, takes time to manage, and you cannot sell a bathroom when you need cash fast. The alternative is a REIT, which stands for Real Estate Investment Trust. A REIT is a company that owns real estate, things like apartment buildings, shopping centers, or data centers, and trades on the stock exchange, just like a regular stock. By law, REITs must pay out at least 90% of their taxable profits as dividends to shareholders. You get regular income without owning a single brick. A 26-year study by CEM Benchmarking tracked 12 major asset classes. Publicly listed equity REITs came in fourth overall, delivering stronger net returns than private physical real estate funds over the same period. They also offered far more liquidity and a much lower barrier to entry. Gold and commodities. Gold does not earn dividends. It does not grow a business. What it does is hold its value when everything else is falling apart. During geopolitical crises and inflation spikes, gold typically rises while stocks struggle. Over the trailing 20 years, gold has delivered a solid annualized return. Silver has slightly outperformed gold on that same timeline because it is also an industrial metal used in solar panels and electronics, which means it moves with the global economy as well as with fear. You do not need to buy physical gold bars. There are ETFs that track gold and silver prices directly, making it as simple to buy as any stock. One honest note, over very long periods, the S&P 500, including reinvested dividends, has historically outperformed raw gold. Commodities are portfolio protection, not the engine of growth. Cryptocurrency. Crypto is real. It is also the highest risk asset class on this entire list. Bitcoin is the original, and many treat it as digital gold, a scarce store of value outside the traditional banking system. Ethereum runs smart contracts and powers a whole ecosystem of decentralized applications. Stablecoins are pegged to the dollar and used mostly for transactions, not speculation. The volatility is not a rumor. In prior cycles, Bitcoin went from around $69,000 down to around $16,000. That is not a dip. That is a destruction of more than 75% of your money. There is also no FDIC insurance in crypto. If you lose your private wallet key, your money is gone forever. If the exchange you use gets hacked, your money can be gone. These are not theoretical risks. If you want exposure, treat it like a satellite position, meaning a small percentage of your overall portfolio that you can afford to lose entirely without destroying your financial life. Act 3. Conflict resolution, the number that quietly destroys your wealth. Most people spend hours picking stocks and 0 minutes looking at the one number that mathematically destroys more wealth than almost any market crash: the expense ratio. An expense ratio is the annual fee a fund charges you to manage your money. A high-cost active fund might charge 1% a year. A low-cost index fund might charge 0.03%. That does not sound like much of a difference. Over 30 years, it is catastrophic. Take two investors. Both put in the same amount. Both earn the same gross market return. The investor in the high-cost fund ends up with a portfolio worth tens of thousands less, sometimes hundreds of thousands less. That lost money is not just the fees paid. It is all the compound growth that money would have generated over the decades. By 2024, 92% of all new money going into long-term mutual funds was flowing into no-load, low-fee index funds. The market is voting with its money. Pay attention to that, the psychology problem, and why it matters more than the math. Here is the uncomfortable part. You can know everything on this list. You can pick perfect low-fee index funds, and you can still lose money. Not because the market failed you, but because you failed yourself. In the brutal bear market of 2022, the S&P 500 declined by about 18%. The average retail investor, however, lost significantly more than that. Why? Because they panicked at the bottom, sold their holdings to stop the pain, and then missed the recovery. That gap between what the market delivers and what investors actually capture is called the behavior gap. It is driven by loss aversion, the psychological reality that losing $100 feels about twice as painful as gaining $100 feels good. Then there is FOMO. When a stock or asset is exploding upward, you feel the pull to jump in. That is usually exactly the wrong time. The crowd has already driven the price up. You are buying the top. And then there is the greatest myth in investing, that you can time the market. JP Morgan analyzed the S&P 500 over a 20-year period from 2004 to 2023. An investor who stayed fully invested the entire time captured the full compounding power of the market. An investor who missed just the 10 single best days over those 20 years ended up with an aggregate loss of 10.6%, 10 days out of 7,300. The best days and the worst days clustered together. They happen during recessions and crashes. If you move to cash to avoid the bad days, you will almost certainly miss the great ones. Time in the market beats timing the market every single time. The man who proved all of this. Back to Ronald Read. He pumped gas for years. He mopped floors at J.C. Penney. He lived in a small Vermont town and patched his coat with safety pins rather than buy a new one. He had no financial advisor, no Bloomberg terminal, no algorithm. What he had was discipline. He bought shares of blue-chip American companies consistently for decades, eventually building a portfolio spread across 95 different stocks. He held through the 1970s inflation crisis. He held through the 1987 Black Monday crash, one of the worst single-day drops in market history. He held through the 2008 financial collapse. He never sold in panic. He never tried to predict the next recession. He just kept buying and holding. When he died in 2014 at age 92, his estate was worth $8 million. He generated a roughly 9,900% return on his deployed capital, outperforming most professional hedge fund managers who spent careers trying to outsmart the very markets he simply sat inside of. Ronald Read did not have a secret. He had patience, and patience is free. How to actually start. Opening a brokerage account today takes about 10 minutes. In the US, Charles Schwab eliminated all commissions on stock and ETF trades, and is excellent for beginners who want a no-nonsense platform. Fidelity and Vanguard are industry standards with massive educational resources. Robinhood and SoFi work well if you want a stripped-down mobile experience with fractional shares, meaning you can buy $5 of Apple rather than paying for a full share. Once your account is open, you do not need to overthink the first purchase. A broad market index fund that tracks the S&P 500 or the total global stock market is where most experienced investors, including Warren Buffett himself, tell beginners to start. If you are building toward retirement, look at a target date fund matched to the year you plan to retire. It handles the allocation shift automatically as you age. Then automate a fixed amount every month. Automating removes the emotional decision from the equation entirely. Halal investing for those who need it. If you follow Islamic finance principles, you need a framework that avoids interest-bearing instruments and prohibited sectors. The good news is that Sharia-compliant investing has matured significantly. Sukuk are Islamic bonds that give you ownership in a real asset or project, sharing in the actual profits rather than charging interest. Islamic equity funds screen out prohibited sectors like alcohol, gambling, conventional banking, and tobacco. Platforms like Wahed offer Sharia accounts that generate returns through stock and options arbitrage rather than lending. In markets like Pakistan, regulated vehicles like the Islamic Naya Pakistan Certificate through JS Bank offer profit-sharing mechanisms fully compliant with Islamic jurisprudence. Conclusion and final CTA. So here is the full picture. Build your cash firewall first, then eliminate the debt that charges you more than the market could ever pay you. Then open a brokerage, pick a low-cost diversified fund, and automate your contributions. Stocks are your primary growth engine. Bonds absorb the shock when markets fall. Real estate through REITs gives you income without the headaches of ownership. Gold and commodities protect you from inflation and crises. Crypto, if you want it at all, stays small. Watch your expense ratios like a hawk. Understand that your biggest enemy is not the market. It is the part of your brain that wants to do something when the market drops. Ronald Read did not time anything. He did not predict anything. He just stayed in. The market does the work. Your only job is to not get in its way. If this video helped you finally understand where to start, hit the like button right now. It genuinely helps more people find this. Subscribe so you get the next one, and drop a comment telling me which asset class you want to learn more about. I read all of them.